Hello and welcome to the podcast hosted by myself, Louis Kessinger, and my dad, Tommy. We are a part of the Kessinger Lee Group at Baird and have been serving investors in our area for 4 generations. Our goal is to start a conversation around topics within the world of finance and to educate you, our listeners. All right, welcome back to another episode. Exciting news to start out with. I think we've settled on a name for this series.
Oh, yeah? What'd you settle on?
We're going to do father-son finance.
Oh, hey.
Keep it casual, pretty self-explanatory, but we're excited to keep bringing you all stuff. We've gotten some good feedback on the previous episodes and snippets that we've posted around on different social medias, LinkedIn, Facebook, sent it out on email chain to clients and gotten some good feedback. So we're glad that hopefully this is helping a few people out there understand some topics in finance, and we will go ahead and dive into our episode today, and that is going to be based on 30 years of experience from this guy right here, and he, over his time in the business, has come up with rules of money management. And my first day in the office, he shared these rules with me, and we live by them every single day.
Yeah, thanks, Louis. So we'll go through several of these, and they'll mesh together. It's 12 or 13, depending upon different items. But number one, we talked about this in our first 2 episodes. Is just make sure you've got enough cash on hand that you can weather the storm in an uncertain economic climate or an uncertain market. And so we've talked about cash. If you have any questions on cash, review our previous podcast. But you've got to have some number that you're comfortable with in cash to help you get through things.
Yeah, and just as he said, you can go back and look at our previous episodes because we've talked a lot about it. But I have written down in my notes here just keeping your safety net safe. Yeah. And so having that cash, having that safety net is step one, but then making sure that it is in an account, it is somewhere, and what we typically like is federally insured treasuries is the safest asset in the world.
Yeah, federally insured deposit. Just keep your mind clear. That's the biggest issue there. So number 2, buy and hold is an unrealistic You've got to be sure that you are evaluating your holdings over and over. Nothing works forever. And so we're in an ever-changing world where things just move on you. IBM used to be the most dominant computer company in the world, and today, if we looked around and took a survey, it would be Apple would be the most dominant, and that change took 25 years to take place. So, we're not traders, but we're trying to express you don't have to own the same things over and over and over forever.
Yeah, and touching on we're not traders, that doesn't mean you have to buy and sell something every single day or every single week, because that has problems in itself. I mean, now you start playing a way riskier game even. But yeah, buy and hold is not the solution.
Yeah, you'll hear people say, just buy good companies and hold them for long periods of time. And in a vacuum, that works great. But in the real world, you've got to evaluate, is that still a good company? There are lots of brand names that have gone out of business. Eastman Kodak, Westinghouse, the list is Polaroid. Those were all great companies and great stocks at one time, but they're no longer even in business at all. The next 3 really are linked with each other, but number 1, cash is king. And cash doesn't go up or down, and because of that, you can use it to buy new investments, whether that's stocks, whether that's bonds, whether that's any other type of financial asset. So cash is king. You want to always have some that is ready to be invested. So this is not the safety net money. This is that money that's out there actively hunting. on that same note, don't ever reach for income with the use of leverage. So if you're trying to increase your dividend income on your portfolio or your interest income on your portfolio, don't borrow to enhance that income. There are products out there, but what I would tell you is just be mindful that you don't want to own something that has embedded leverage in there, and or you don't want to go borrow money, say at 3%, and turn around and try to make 7% on that, because that money's due no matter what. And so just be very careful of that. And then finally, on this piece, I would just say be very careful of owning corporate bonds. You want to make sure you're doing your due diligence on those. Corporate bonds, AAA rated corporate bonds, never ever go bankrupt. And the reason for that is because they always get downgraded. So a AAA corporate bond will go down in rating. It'll go to double A, it'll go to single A, it'll go to junk bond status, and it'll keep falling. And that's why they'll say, oh, AAA bonds never go.
Yeah, and the point on leverage, I think, is so important to make, because leverage can be really, really enticing in good times.
Yeah.
Right? I mean, you see something and you can double your return with the use of leverage. Well, that's awesome. Okay, well, it's also double on the downside.
Yeah, you could actually owe more than what the asset was worth at the time of the leverage. So you just please be very careful when you use leverage. There's loans, margin, all those things come with big disclosures, and there is a reason for that.
Yeah, and the next rule deals a little bit with that, not with leverage, but with the risk of loss. Yeah. And you have written down here, never ride a stock to zero. You want to touch on that a little bit? It sounds obvious, right?
It does sound obvious, but it is hard, because in our minds, when we buy a company at a certain price, we feel like that's the price that company is worth. And so everything revolves around it. And when a stock drops precipitously, maybe there's new information, then people want to wait. Like, I'm going to wait and sell that stock, whatever it is, when it gets back to even. And when it gets back to even, I'll get out and I'll feel better about it. But it changed. Like, the story changed, or the fundamentals of that business changed. I don't mean to beat up on Eastman Kodak, but it's irrelevant for probably the people. You took pictures and you developed them at your local pharmacy, and they gave you photos back. Well, Apple and digital technology destroyed that.
Now, we're sitting here recording on an iPhone, right? And we can see what we're recording on a computer that's made sitting right in front of us. I mean, the technology changed, the story changed. That business model was no longer viable.
No longer viable. And so that's obvious to say today, but in the middle of it, right, you hope, but you cannot ride a stock to zero. You've got to have capital available to buy a new investment that will lift you out of the hole that perhaps you've dug yourself into. So don't be afraid of taking that loss when the story or the fundamental has changed. Super, super important. All right, that coupled with that is this idea of diversification. And a couple of rules we have are we want to be really careful not to have too much in any one stock, and really any one industry.
Right.
So if I've got 15% of my total holdings in one stock, red flags should be going off. I should be thinking about ways to reduce that by giving it away to a charity, to my children, to somebody else, selling a little bit of it, reducing my exposure, buying something else, buying cash what have you, but never have more than 15% in any one
Yeah.
holding or industry. Really.
Yeah. And that's the whole idea of diversification and diversifying your portfolio. And sometimes it's easy to think, oh, I own different companies, I'm diversified. Well, if you own two oil companies, you're not diversified at all.
Right.
You just own two different companies. So owning things that move in opposite directions
Yeah, that would be
is
the best. But,
right.
You know, realistically, stocks move sort of with each other, but some sectors move more than the others. And so
Right.
the idea would be to buy a basket of really well-run businesses, always evaluating them, and
Right.
never letting something get to be too dominant. Because if you have a position that gets huge in your portfolio, let's say it's 20%, and it drops by 50% or more,
Yeah.
that's a devastating loss.
Yeah.
Right? And can really hurt your net worth.
And the other thing to keep in mind is the reason you always want to be evaluating your portfolio, and the reason we are always evaluating the portfolios that we manage, is that when you enter into a portfolio, each position might be 2% of that portfolio.
Right.
And then you get a stock that goes on a great run, they have an awesome year, and they're now 10%, and they're kind of in, maybe it's not a red flag yet, but it's a yellow flag, and we're looking to make sure, hey, we don't want this thing to be the dominating position in your portfolio. We want to make sure that everything's kind of evened out and balanced. Yeah, great word, balanced.
Well, and so on that note, the next rule is you've got to calculate your annualized returns. And what I mean by that is I use the example of General Motors. So General Motors, purchased in say 1947, had the same value in 2008. And so, if you just bought and hold that, then for 60 years, you had the same value. Now, unfortunately, I have that down here on this sheet because GM went through a bankruptcy restructuring in 2008. And so if you had anything in it, you actually lost that.
Yeah.
But if you had checked your annualized returns over a certain period, you would have realized like it did great in the 60s when the car boom was going through the roof. But then as it tailed off into the 90s and 2000s, your annualized returns were down to zero.
Yeah.
So you rode it all the way up and you rode it all the way down. I call that a round tripper, and that is just no fun.
Right. Yeah. And then you talk about risk management and maybe how to manage some of the risk in a portfolio or a certain position. Talk about some of the strategies for that.
Yeah, there's lots of things in today's world that can help you with this. There are specific orders where you can put in a stop loss. So, and those are complicated orders and need to be discussed with your financial advisor. But you can put a price limit on what you're willing to sort of lose there. You can use hedging strategies. There are lots of different hedging strategies out there. There are other financial products that will go down when the market's up, that will go up when the market's down, and those can be of assistance to some professional investors. But the big thing is keep this idea that there is risk involved in investing, and how do I mitigate that risk, or or most importantly, am I comfortable with the risk I'm taking?
I think, too, in some of these risk management strategies, a big part is that you're saying, okay, if this stock falls by this much, then I'm out. And you no longer have to make a decision.
Right.
So it can get emotional owning some of these companies, and it's hard to sell because, like you said, you did your due diligence, and you have in your mind what you think that company or that stock is worth. Whereas if you, at the time you buy it in the first place, say, all right, if we fall this much, I'm out. I don't want any more. You've taken that emotional attachment out, and you don't have to make that decision because the past you already made it.
Yeah, I mean, every one of these rules came because of times during the market cycle that there were emotions involved. So all of these are designed to reduce the amount of emotion. So let's talk about one thing, and that is one of the things we talk to clients about is trying to reduce or eliminate their trading costs.
Yeah.
So trading costs can also have an emotional adherence or can be an emotional roadblock to people on there. And so that's why, in our practice, we charge a fee for managing portfolios so that there are no trading costs.
Yeah.
When you have trading costs and you buy a stock for $10,000 and there's $100 trading costs, some commission, and it doesn't go the right way, then psychologically you don't want to then sell it at $9,000 and have another $100 trading cost, and then you got to go buy something else.
Right.
So a third trade.
Yeah.
So you've spent $300, you've lost money, and you don't even know if the third trade's going to be any good.
Yeah.
So, eliminating or reducing your trading costs by either doing it on a fee in a managed type of an account, or doing it on your own in some low trading cost situation there. It doesn't matter to us. What we want for you is to just reduce that friction so that you're not thinking about how much commission I just spent to do a trade that could be better for me. Because if I have $10,000 investment, it goes to $9,000. The story changed. Eastman Kodak's getting out, and I can put that in something else, and it goes up multiples of that.
Yeah.
Then I would hate to not do that because I'm trying to save a couple of bucks on commission.
Yeah.
So eliminate those frictional trading costs.
Yeah. I kind of like to think of it as you get to start at the starting line.
Yeah.
As opposed to paying the commission and your start, like you need the stock to go up just to get back to even. Yeah. And so that fee-based managed type accounts are really beneficial to the investor and to the client, to you the client. And along with that fee, you not only get the portfolio management, but you get the planning piece. All kinds of stuff are wrapped into that fee. And
it's more than just not paying for the trade. It's,
right.
It's part of the total wealth management experience.
That's right.
Okay, one of the last things on here is I just want to help everybody. TV personalities and or people that you see on TV, and they may be.
Or on Facebook, or on Twitter, X, wherever it is you get your media.
What own set bias in terms of what they're trying to do. Some of them may want the market to go up. Some of them may want the market to go down so that they profit. And so it's always good to maybe listen to those personalities, but try to understand what angle they're coming from. A lot of those TV.
Right.
Yep. And there's an old adage in the newspaper business called "if it bleeds, it leads." So if it's horrible, that's what we're leading with. That's how we can get more viewers in. So just what we would say is be cautious of putting too much faith into what any one person says, and then make an informed decision.
Yeah. Yeah. I had a thought and I've lost it. So
well, that's okay. Those come and go from time to time. These money management rules were developed, as Louis said, over 30 years, and they're always evolving as markets evolve. And so your money management rules should evolve for your individual situation. We try to take them and help people make really good, really well-informed decisions. And as Louis has heard since he was very small, an informed decision is the best decision. And that's what we want for you. So we hope you'll be able to use these and develop your own set of money management rules.
Absolutely. We appreciate you for listening to us once again. I hope we were able to all gain a little bit of wisdom from 30 years of experience here and some money management wisdom pieces. Thank you.
This podcast is intended for informational and educational purposes only. It is not an offer to buy or sell or a solicitation of an offer to buy or sell any security or investment or to participate in any particular trading or investment strategy. The information is considered to be from reliable sources, but its accuracy is not guaranteed. We do not offer legal or tax advice, so please consult your tax or legal professional for information specific to your situation. The opinions expressed are those of the speaker and not necessarily those of Robert W. Baird & Company Incorporated. Please note past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. You should carefully consider investment objectives and risks of any investment before investing. An investment cannot be made directly in an index. Securities and investment advisory services are offered by Robert W. Baird & Company Incorporated, a registered broker-dealer and investment advisor, member NYSE, FINRA, and SIPC. You should consider the investment objectives, risks, charges, and expenses of each money market fund carefully before investing. This and other information is found in the applicable prospectus for the money market fund. Contact your Baird financial advisor for a prospectus. Please read the prospectus carefully before investing. Money market funds are managed to maintain a stable $1 share price. An investment in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Although the fund seeks to preserve the value of your investment at $1 per share, it is possible to lose money by investing in the fund.